Welcome to Chapter 1 of Essentials of Investing. In this chapter, we're going to talk about the background and issues of investments. And first thing we're going to talk about is real versus financial assets. So we have real assets, and they produce what their productivity capability is, and how that relates to output of goods and services and the economy. So basically, when you're thinking about real assets, these are tangible assets like land, buildings, equipment, machinery. And these are assets that can be used to create goods and services for the economy. So everybody has a really good idea of what real assets are because they're all around you. Now, financial assets, such as stocks and bonds, those are a little different. So these are really contracts or value represented in some sort of paper form, so not directly physical, and they don't directly contribute to the productivity of an economy. Instead, if you look at these financial assets, they're claims to income that are going to be generated from real assets. So financial assets are a tool that we use where investors can invest in real assets of a company, to generate a compensation. So the share income is going to be, derived from the company's or the government's ability to generate income. Now, real assets, which we're familiar with, they're going to generate net income as being part of the economic system. So financial assets simply are an allocation of this income or wealth among investors in those financial assets. So as an individual, you can choose to consume your wealth today by buying things, or you can invest in your future by buying stocks and bonds. So if you choose to invest your wealth into financial assets, you're going to be buying stocks, buying bonds, various types of securities. And generally you're going to be buying these, that are directly issued from a company. So that the money is going to be used for these companies to open new locations, buy plant, equipment, machinery, research, development, technology, so that the company can ultimately become more successful and more profitable down the line, and then return money to the investor and firm in capital gains or in dividends or interest. Now, if you think about real assets, as we compare them on a balance sheet, you can see that in the United States, here's the balance sheet right here, and this is of 2017. So, in the United States, for example, what this balance sheet is based on, which is going to include wealth in the form of, financial assets such as bank accounts, corporate bonds, stock. However, debt securities, which are financial assets that households can hold them, but they are liabilities to the issuers of those securities. So for example, if a company issues a bond, that's going to be a liability on their balance sheet, but as an individual who invests in that bond, that's going to be an asset on the individual's balance sheet. So when a company takes that money, they're going to, from a bond that generates from a bond, they're going to invest in, say, a new manufacturing facility. And from the proceeds of the products they sell produced in that facility, they'll pay interest to the shareholders on that bond. So you can see on this slide, as far as the real assets, most of the households have the majority of their real assets in real estate, which makes sense. And then as far as financial assets, most of them are in some kind of pension reserves, which could be like a 401k or pension from a workplace employer or a 403b. Now, as far as in businesses, it could be in mutual funds, other debt securities, so directly in business. So you see deposits would be deposits like in a savings account, and so as far as equity in a corporation, What they mean about here, a non-corp, basically you can access equity through a variety of financial instruments. Now, as far as liabilities, most Americans' liabilities lie either in the mortgage or consumer credit, like credit card debts. Okay, and this is the average net worth at that time was $107,000. So financial assets and liabilities, they have to balance, and that's why we call it a balance sheet. So financial assets, owner of the claim; financial liabilities, issuer of the claim. So they have to balance in order for the balance sheet to be completed. So if you aggregate the balance sheet, only the real assets are going to remain after the financial assets and the financial liabilities are balanced. So domestic net worth is ultimately going to be the sum of the real assets. So here's, as far as some domestic net worth, look at commercial real estate, residential real estate, and this is in the billions, so these are trillion, 18 trillion, 33 trillion, equipment and IP, inventory, consumer durables. So they're saying that the domestic net worth is about 67 trillion. Okay, let's switch over to discuss some of the common financial assets and the asset classes. So there were, three very, broad types of financial assets. We have our debt, our equity, and our derivatives. Now, most investors will be involved in equity and debt, but some investors will choose to work with derivatives as well. And in this series of lectures, I will give you some more information about derivatives, starting with this chapter, and then towards the end of the course, a little bit more on derivative chapters when we talk about options and future markets. Now, fixed income or debt securities, as they're sometimes known, which are basically bonds, they're going to promise a fixed stream of income. So how this basically works with, when they call them fixed income securities, because the amount of interest you're going to receive from majority of these are fixed, and most people will invest in these in the form of bonds. But there are also, in this classification, money market instruments and preferred stocks would also be considered a fixed income security. So basically, you are going to lend money to an entity, a government or a business. They are going to pay you interest to compensate the risk and return of the investment, and then at the end of the period, whether it's 10, 15, or 30 years, you get your principal back. So you may invest $1,000 in a bond in year one or year zero, and then 30 years later you get that $1,000 back. However, $1,000 in 30 years is not the same as $1,000 today due to inflation. So the interest payments that you receive along the way, those 30 years, are meant to compensate for the devaluation of the currency through interest, as well as compensate you for the risks of being invested in that fixed income security. Now, the corporate bond is pretty typical, as well as a treasury bond, and they can have other types of features like floating interest rates. So it really depends on the specific bonds. A lot of people are invested in treasury bills and bonds, and those have a much lower risk because they have a much almost zero chance of default, where corporate bonds have a much higher chance of default. So the less risky a debt security is, the lower the interest or the lower return you're going to get on it. But debt securities are, they come in a very wide differential of maturities. So, but most of these will pay interest in a semi-annual basis, twice a year. Although some debt securities, like mortgage-backed securities, will pay interest on a monthly basis. And some money market accounts will do it on a quarterly basis. So it all really depends on the instrument that you're going to be investing in. And so you have a wide range of investment choices when it comes to bonds, whether it's municipals, treasuries, corporate bonds. There is going to be something that will fit most any investor's risk profile or term of investment profile. When I say term of investment, how many years they want to be invested. Now, of course, there'll be more information about fixed income securities, common stock, and derivatives throughout this lecture series. This chapter is meant to introduce them. Now, another area that's probably a more exciting area, or an area people are more familiar with, would be what we call equity. So equity is another name for stock or stocks. So when you hear a show, maybe on TV, or you're reading a book and they're talking about equities, what they're really talking about is stock, which represents an ownership in a corporation. So equity holders are not promised any particular income, although owning a stock, you could get paid a dividend, but by and large, only preferred stock and bonds have a schedule or a set promise to pay interest rates or dividends, where equity doesn't. Though it doesn't stop some companies from paying regular dividends to equity shareholders, but they're not required to. Now, the real value of equity is that the increase of the per share price, which we call a capital gain. So that's really why people buy stock, is because they're hoping that the companies become more valuable and stock prices go higher. And that is directly tied to the success of the company. So if the company is successful and they're able to expand and grow, then their share price will grow as long as the company is increasing sales and earnings per share. And finally, a derivative security, and the most common derivative securities you would encounter as an individual investor would be options. But future contracts are also within this category of derivative securities, and they derive their value from other assets, such as stocks, bonds, or commodities. So you can have option contracts or future contracts written on oil, on grains, on sugar, on just a multitude of financial instruments as well. Could be represented in the futures or option markets. But by and large, most option contracts are going to be centered around stocks. So it's just a contract which derives its value from another asset. And in the contract, you're making an agreement to be able to buy or sell the underlying price that's going to be tied to the asset. But more derivative securities will be talked about in more detail towards the end of the lecture series here. Now, one thing about derivatives that have a little bit more of a unique value to hedge risks or transfer risks between different parties. So this is sometimes one of the real benefits of derivative securities, is that the ability for companies and individuals to hedge their risks. And the derivatives market, although it's not so commonly known to the average investor, hedge funds, large banks, corporations routinely engage in the derivatives market. And for some investors, you can take highly speculative, highly leveraged positions. So for the average investor, that type of risk is out of scope. But for some more professional investors, these derivatives offer opportunities at a much heightened level of leverage than you can encounter with equity. So even though they are riskier, these derivatives do have certain advantages for corporations who want to hedge or manage their risks. And we'll talk more about that in a later chapter. But keep in mind that derivatives can be on commodities, like I said earlier, like oil, as well as raw materials. So they are a multifaceted, multi-asset class type of financial asset. Okay, so let's move on here. Okay, so let's talk about financial markets and the economy. Now, when the economy is really sort of the accumulation of business, trade, and transactions that occur with either, and the economy can be broken down to a very local economy, to a regional, to a state, to a nation, to a world. So the economies can be looked at from various points of view. So financial assets hopefully will represent what's occurring in the economy. So when we look at stock prices, this is going to be, as far as you look at stock indexes like the Dow or S&P 500, this is going to be a collective assessment of how the economy is doing, where individual stock prices would be more of an assessment of how a company is doing. So if a stock price is going up, we'd assume that the company is doing well, performing well, or that the future prospects of the company is going to be more optimistic when the share prices rise. So higher prices make it easier for firms to raise capital, to inspire confidence, to encourage investors to continue to invest with the company. And stock prices, of course, are going to play a major role in the allocation of capital in most major economies. So when firms raise capital, it means that they're selling stock or bonds to investors. Now, investors feel wealthy as they see their value of their stocks increase, and that gives them a sense of overall confidence in the economy as well as the corporations. Now, it's difficult to figure out which of the proper stocks to buy because no one's going to be 100% sure which companies are going to be successful and which companies could fail in the future. So markets, although more often than not, markets are accurate as far as their assessment of individual companies in the economy, but that's not always true. So markets, the timing of the markets can have issues as far as their valuation of stock prices. And you have a lot of well-educated, well-experienced professionals who analyze firms and who trade stock on the stock market based on how they feel the company's doing, and they do this for a living in trading of mutual funds. Now, so we assume that the stock price, sometimes called the market price, so you see here where it says, whenever you see market, that usually means stock market. So they just say market for short. So market price is going to equal the fair price that the company should be valued at. And that would be, if the market is efficient, the more efficient the market is, the more accurate the stock pricing is to the true value of a corporation. Now, one thing that we have to think about is sometimes the stock market can be in a bubble state, which would be an overvalued state or an undervalued state. So that could affect the overall, sometimes stocks could be more overly valued than they should be based on exuberance in the stock markets. So companies that are doing well and have strong stock prices will make it easier for them to issue future bonds or issue additional stock in the future and raise more money, which helps them to have a competitive advantage. Now, let's now talk about consumption timing. So, as an individual, if you're earning more than you currently wish to spend, you have an opportunity to invest that money. And if you're going to invest that money, you're looking for a future return that's higher than your current savings. So for example, if you look at the age of an individual in this particular slide, when you're young, you generally spending more money and you're not saving, whether you're paying for school or you're just starting out in a job at a lower income, you're borrowing money for a mortgage or a car loan. But then as you age, there's a certain point where your income's going to be greater than your consumption and you'll be paying down your debt and then saving until you get to an age where you hit retirement, where your income dries up, and then you start utilizing your savings to live on. So that's sort of the consumption timing as far as how you're going to spend money versus save money, and how you're going to shift your purchasing power from high earning to low earning periods of your life. And this is why we save for retirement. And the best way to save for retirement is in stocks, because stocks beat inflation. So your money will grow, it'll compensate you for inflation, and you'll have more money. The compounding of this will help lead to having a comfortable or successfully funded retirement. Now, let's talk about risk allocation. Excuse me. So, all assets that you invest in or own are going to have some risk. If you buy a new electronics product like a new PC or laptop, and you don't get the warranty at the store, there is a risk that after a certain period of time, that product could fail. Now, if you have a manufacturer's warranty for a year, that's going to mitigate some risks. Maybe you get an extended warranty for 3 or 5 years, but warranties are valuable because it helps to reduce the risk of the asset you bought failing and you losing the money for it. So when we look at companies, when they're going to invest, they can't know for sure that the cash flows are going to be sufficient. Cash flows are going to be generated from the investments they make. Whether you're a fast food franchise that is going to open up new locations, you probably are relatively confident in the cash flows they'll generate, but they're not guaranteed. So there's a certain amount of risk. So the financial markets are going to and the financial instruments traded on those markets, stocks and bonds, they're going to allow investors to generate, to trade some risk for return. Now, if you're, depending on what your risk tolerance is, well, risk tolerance, I mean saying how much risk do you want to tolerate, and the more risk you take on, hopefully the more return you should generate. So if a company is going to raise funds for through stocks and bonds to the public, they are hoping that the risks of the company has in operating the business and generating wealth will more than compensate the shareholders who invest in the stock. And if they do it well, shareholders will continue to invest in the company and the stock price will rise. Now, if it's a situation with bonds, if the lower the risk the company is, the lower the fixed payments will be for the bonds, because, for example, usually government treasuries have a lower interest payment than corporate bonds because there's less risk involved. So risk is directly correlated into the amount of return you get. So the risk allocation, that you need to kind of understand how much risk do you want in your portfolio, and this risk return characteristic that suits you best as far as your time horizon for investing and the amount of return you want to receive. So as far as investors are concerned, they're going to look at stocks versus bonds and the risks associated with the two. What's the risks of a bank CD versus a company bond? So a bank CD, generally insured by the government, has very low risk and very low interest rates. But company bonds would have a higher interest rate because of this higher risk. So that would be the risk expected return trade-off, where we're expecting to get a higher return when we invest in riskier assets. So let's talk about the separation of ownership and management. Okay, so think of yourself as a small business owner. You're going to own the business and manage it at the same time. So that keeps things relatively simple, and you're going to act in your own best interest because it's your business and it's your investment. So you're going to be probably the most diligent and the most reliable to run that business because you're directly going to benefit from that business. Now, at some point, businesses get too big for any one person or owner to really completely handle. So when you have a large-scale business with a lot of capital, that's going to have a different environment as far as how the ownership and management are going to be separated. So a large company, obviously, a single person can't actively participate in all the day-to-day management decisions. So what's going to happen is, if it's a large company and if they've already issued stock to help fund and grow the equity of that company, you use the money from the equity to grow the company, then they're going to have to, the shareholders are going to have to elect a board of directors, who in turn are going to hire managers to manage the firm. So the structure means that the owners and the managers are different parties. The owners are represented by the board, and the management is going to be hired and monitored by the board, and this gives some sort of stability between the owner-management relationship. So shareholders are a little bit more protected because the board is there to protect the shareholders, and the management is going to be put in place, and their decisions or actions or success or failures will be directly monitored by the board, and they'll be awarded or fired based on their accomplishments. So this is a way of a check and a balance to keep financial assets on target to deliver the best results for the investors, not what's best for the individual manager. So financial markets make it much easier to separate this ownership between the management and the owners of the company. Now, if we look at, there are some unique problems that can occur that, specifically we could talk about agency problems. Now, so managers who are working for a business, their goal is to maximize the shareholders' wealth. That should be their goal. But, these managers can be tempted to engage in activities that are going to be the best interest of themselves, not shareholders. So they might engage in taking on, they could engage in behavior that might, here's an example of how an agency issue, a conflict of interest between managers and shareholders could develop. So a manager may want to hire family members and pay them well or pay them above the market value because it's going to directly benefit his family. Well, shareholders are not going to get a direct benefit because now they're paying higher wages for positions they could hire at a lower rate. Also, managers may decide to purchase contracts, like an oil contract, for energy, or a particular vendor contract, due to a personal kickback. So they might choose a meat vendor who's going to give the manager 8 free steaks a month just because they chose. Now, he didn't chose the vendor because of the lowest cost and the best quality. He chose them because he personally is going to get the highest kickback. So these are things that are agency problems where the manager's not always engaged or looking at the best results for the company, but they're looking at what's going to benefit them more. Now, how do we prevent these agency problems? Well, of course, we have performance-based compensation, and this is where we're going to compensate the managers based on how well they perform. So the compensation plans are going to, sometimes they can be tied to stock performance. So the top executives, we want to incentivize them to increase shareholders' wealth. So if we tie the shareholders' wealth to their performance or their returns, then that supposedly should keep them more in tune with what's going to benefit the shareholder. However, this sometimes can backfire if they're over-incentivized. They may do things to push up the stock price that in the long run would not be good for investors. So it could be too much short-term planning to increase the short-term stock price, not long-term. Or they could falsify revenues and profits to increase the share price, which is, fraudulent. So, in this case, the board of directors has to really closely monitor these performance-based compensation. And if they find that managers are doing things just for the sake of increasing their compensation, but wouldn't be a good long-term position for the company, they should be fired. So board of directors can fire managers if they feel that they're not performing in the best interest of the company. So bad performers are going to be, as far as companies, if the companies are performing badly, they may be subject to a takeover. So if the board of directors is not really doing a good job and shareholders are unhappy, they can also elect to elect a new board member or have an election to elect a new set of board members who they feel would be better suited to running the company. So these are just different things that the management and the ownership of companies have to engage in together to make sure that everybody's working to the best interest of maximizing shareholders' wealth for the stock investors. Now, 2 areas that can help is to help a company be more honest and more transparent and more in line with what shareholders need is 2 things: corporate governance and corporate ethics. So with corporate governance, this is going to be a set of guidelines for the government, for the corporation, and how the corporation is going to be run. So sort of like a rule book of what the guidelines are for the business to run, so that hopefully this corporate governance is going to encourage confidence in the firm's ability to honestly record the transactions of the business and honestly represent what the business is doing to shareholders. Now, so if we look at a company, they're going to have to set policies up that are going to help have a more useful and beneficial set of corporate governance rules. So there were companies in the past with poor corporate governance, companies such as WorldCom, Enron, Lehman Brothers, things of this nature that did not really act in the best interest of shareholders, did some unscrupulous things, unethical things, which wound up devastating the stock price or even destroying the stock price to the point of bankruptcy and bringing the stock price down to zero. So anytime these scandals take place, generally at certain points, governments can get involved and actually dictate certain minimums for corporate governance. Now, scandals are nothing new. There's often a lot of wrongdoing that occurs in the business world, but it's the job of the participants in the businesses and the governments to make sure that they could reduce as much as possible unethical behavior or abusive corporate actions. So in practice, companies should be audited, and the auditor should be fully independent, something that was a problem with in the early 2000s with Enron and WorldCom and Global Crossing, that the auditors were not fully independent of the company. Their businesses were mixed, which clouded the performance of the audited companies who didn't want to upset their business interests in the company they were auditing. So it led to a much softer review and oftentimes left out key pieces of information shareholders should have known about. So oftentimes the government, like the U.S. government, passed the Sarbanes-Oxley Act in 2002 to help tighten the rules of corporate governance and to make corporations more accountable to their actions, so that specifically CFOs now personally after this act had to vouch for the corporate financial statements, put their name to it and say they're accurate, and also increase scrutiny for auditors who look over and review these financial statements. So think of corporate governance as the rules and regulations a company sets up for itself to keep the company checks and balances, honesty there. And then corporate ethics is just the actions of the management and the company. Are they ethical as far as what's considered ethical at that particular time? Now, if a company is deemed to be unethical, that is going to be very bad for the stock price and the overall image of the company. And there have been companies who have done things, specifically make products they know will hurt or kill people and not go and recall or fix those products because doing the calculations, they realize that a recall would be much more expensive than paying the legal fees if an incident did occur with damages from their products. So these are certain unethical things that do not go over well with shareholders. Now, as far as what I was talking about before, there have been accounting scandals. Some of the biggest that I had just mentioned: Enron, WorldCom, Rite Aid, Health South, Global Crossing, Quest. These were all companies that purposely manipulated their financial statements and accounting results to make the company look much better financially than they were. And why did most of this occur? Well, it was because of the compensation of managers tied to the share price that over-incentivized them to the point where they made lied and falsified revenues and profits to only in the magnitude to increase share prices, so they would personally be compensated more greatly. As far as misleading research reports, Citigroup, Merrill Lynch, and others are responsible for producing research reports about other companies, bonds, or stocks that were grossly inaccurate, mostly to protect the business relationships they had with these companies. And then finally, auditors, who were supposed to be independent groups that monitor and review the validity of financial statements, they have, in the case of Arthur Andersen with Enron, they can act unethical when they look the other way or discover problems with the company and don't report them and don't highlight them because they're worried about their business interests. Now, that Sarbanes-Oxley Act was a response by the U.S. government to correct some of these corporate governance and corporate ethic breaches over the last 20 years. So now companies are required to have more independent directors. CFOs are personally have to verify and sign financial statements. Oversight boards for the accounting and audit industry were set up, and change boards with maintaining a culture of high ethical standards were now the norm. Okay, so let's switch over to the investment process, and we'll talk about asset allocation. So, the asset allocation decision is going to be a choice that you're going to have to make as far as what collection of assets you want in your portfolio. So the security selection is going to be a method for accumulating these different assets. So if you as an investor, you're going to want to have a portfolio that is diversified, and that means you're going to want to have a different set, a varied set of assets within your portfolio. And that allocation of the assets in your portfolio is what we call asset allocation. And this can be rebalanced by selling partial amounts of some securities, buying new securities, depending on how the overall environment changes, specifically with with risk. Now, the top-down investment strategy here, and this is just a typical, if we see here on the screen, equity, bonds, and treasury bills. This could be a typical allocation for a retirement account. Now, the top-down portfolio strategies, we'll start with asset allocation. So individuals will have a certain amount of money that's earmarked for investment. So they're going to decide what portion of each portfolio they want to put in stocks and bonds and other investments. And this is hopes to establish a more stabilized return and a lower risk. So, if you look at the return on common stock from 1926 on till today, there's been and this is primarily U.S. equities, there's been a 12% increase or return on U.S. stocks. Well, there's only been about a 4% return on U.S. Treasury bills. So, but Treasury bills are a lot less risky. So having a portfolio that's made up of both stock and bonds is a way of mitigating some risks, because the correlation between the two, often when stocks are falling, bonds are increasing in price. So they can kind of balance each other out, make a more stabilized portfolio. Now, so the what we call a deviation of return is the risk or deviation of return for bonds is a lot lower, but for equities it can be much higher. And you can have years where you lose 40 to 50% of your money in equity, and you have years when you can earn 50% or more of your money on equity. So the diversion of returns are quite larger for equities, stocks, than they are for bonds. And that's something that we have to think about for risk. And so this top-down investment strategy, we're going to, of course, start with the asset allocation, and then we're going to look at critical assets to put into our portfolio to meet a particular set of needs of the individual investment. So let me go back. Okay, so here we see, I lost that visual, sorry about that. I was just showing how your allocation can change in your portfolio as time goes by. So for example, when you're younger, you would want a more aggressive asset allocation, more heavily on equities and stocks. And as you get older, you want to transition more into bonds. So So a bottom-up investment strategy is going to start with security selection and then work up to build your portfolio. Now, let's talk about the risk-return trade-off. So, of course, assets with higher expected returns should have higher risks. So, if you look at, like what I was saying before, the annual return of stocks would be 12%, but we do have these minimums and these maximums of return that can be quite scary. So stock portfolios make money an average 75% of the time, or lose money an average of 25% of the time. And that is, the 75% of the time you're making money is great, but the 25% of the time you're not making money is pretty scary. Now, bonds have a lower average risk and a lower return, but sometimes when you mix bonds and stocks together, it makes a much better portfolio. And that's how we would talk about a risk-return trade-off. So in the risk-return trade-off, we're thinking about future returns. So the returns that we can reasonably expect to receive in the future, we want to think about what risks are involved with those investments. So we have a better idea of what we're getting into. So if we do invest in something that's riskier, we're going to require a higher return. And if we're going to invest in something that's less risky, we have to be willing to accept a lower return, and that's a risk-return trade-off. So investors, of course, prefer investments with the highest amount of expected return, but this is going to come at a higher expected risk. So that's why investing time horizons are important. So if you have a long-term time horizon, this helps to greatly reduce the risks that you'd face in any one particular year of a stock portfolio. Because like I said before, 3 out of 75% of the time you're going to make a profit. If you invest for just a 1 year time horizon, and it happens to be the year with the bear market, you might lose 25 or 50% of your portfolio. So that's why longer term investments, time horizons, can help mitigate some of this risk-return trade-off. So, if an asset is going to have a higher expected return, you're going to also be assuming extra risk. So investors really need to think before buying any type of investment with a high risk, as far as specifically looking at the time horizon they have. So the price will rise until the expected return is no more than it should be to compensate for the risk in an efficient market. So a fair return is going to be relative to the risk of the asset in a perfect market. But the market is rarely perfect in its valuation of all the stocks. And when you see times of stock bubbles or stock busts, this is more evident that sometimes the stock market is not fairly valued or efficient. Now, so there needs to be a risk-return trade-off when you're investing in securities, and this is what investors who are smart realize, what risk they're able to tolerate. And if the risks, because if the risks are too high and the investor is going to sell when there are losses, that investor will never make money. So there are questions. How should you measure risk how should you measure the risk of an asset? What can you use? During this lecture series, we'll talk about some of those quantitative measures to look at the trade-off between risk and return, and how to calculate expected return. So volatility of the asset is one way that we could really gauge the risk of an asset. So we could use the volatility that we sometimes measure with beta as a better way of looking at how we measure risk and how does diversification affect our risk. So diversification, we're just going to means that we're going to include many additional assets within our portfolio, sort of that don't put all your eggs in one basket idea, and that the effect of this diversification can help reduce portfolio risk, but not all the risk. Basically, later on in this lecture series, we'll talk about systematic and non-systematic risk, and diversification can help reduce one of these risks, but not both of them. Okay, so let's talk about efficient markets. So markets, think of a market of the stock market. Think about how many people are buying and selling stocks inside that stock market. How many smart people are analyzing stocks, and when they find that a stock is undervalued or underpriced, they're more likely to buy it. And stocks that are overvalued, then smart investors would want to sell them. So this is what keeps this buying and selling, supply and demand of stock should keep the markets efficient, meaning that whatever price, if the efficiency was running at 100%, whatever the stock price is the 100% fair value for that stock. So if all the information is reflected or known about that stock, then the stock price should be accurate. So if you believe in an efficient market, then it means that you're never buying something at the wrong price. Now, unfortunately today, the efficiency of the market varies. Some points in history, the market's very efficient. At some points, it's not as efficient. So this is something that investors have to deal with as far as, because the market's not 100% efficient, there are often sometimes bargains that can be found in the stock market, in individual stocks. So there is some evidence to these hypothesis of efficient markets, and a lot of research has been done. It's never been proven 100% conclusively, but some evidence does exist for efficient markets. Now, it'd be nice if markets were, highly efficient, because then we would never be overpaying or underpaying for a stock. But sometimes the inefficiency of the markets can lead to some stock trading advantages. So a management style investment company who are looking for these inefficiencies in the efficient market can generate higher than normal returns by being good at spotting these inefficiencies. Now, so that leads to sometimes two types of styles. You might have a passive management style, which is just looking to make a diversified portfolio, not really looking to manage or analyze individual stocks, but just sort of investing the S&P 500 or the Dow Jones and having a very passive management where they're doing very little security analysis and just being a participant in the market. Where active management is going to be going to attempt to improve the overall performance, meaning get a return higher than the market by finding securities that are underpriced that they can buy, or securities that are overpriced that they can sell short. So if markets are inefficient at times, the more inefficient the market, the better chance the active manager has at making above average returns. So passive strategies have been a little bit more popular in the last 10 or 15 years because they have produced consistent results, and generally the passive strategies have higher returns than the active strategies. But some active strategy managers do beat the market. So we'll look at the efficient market hypothesis more closely in later chapters, specifically chapter 9. But bear in mind, the idea is that because of all the trading in the stocks, markets should be near efficiency. And it's a matter of belief is of how efficient the market is overall. So these active managers, this would be a mutual fund manager who's going to be buying undervalued stocks, doing market timing, where a passive manager is just looking for efficiency. Just duplicate the S&P 500, and there's no attempt to time the market, and just produce a return equal to the market. So these are two different schools of how things can be invested in. Okay. So now let's look at the players. So you have businesses. Sometimes businesses are called firms, and they're net borrowers. So in total, businesses borrow most of the money. Households are the net savers. They're the ones who save the most money. Now, governments, depending on which government you're talking about, can be both borrowers and savers, but generally most governments are more heavily on the borrowing side. Now, financial intermediaries, these are our institutions that can connect the savers to the borrowers. So we have commercial banks, investment companies, insurance companies, pension funds, and hedge funds. These are all examples of financial intermediaries that are going to take the savers' money and move it to the investors' hands. So this is important because as an individual, you can't directly buy a stock market. You need a brokerage company or investment company to access the exchanges for you and buy the stock for you. So there's a disconnect between savers and direct borrowers, and the financial intermediaries are the ones that fill that void. So they bring together the suppliers of capital to the demanders of capital, and so for example, banks, they're going to raise funds by taking deposits, and they're going to lend this money to other small businesses or even other individuals who maybe want to use it for a mortgage. So these intermediaries they're unlike other businesses because both their asset and their liabilities or ownerships are overwhelmingly financially based. So they don't have as many of the real assets, land, equipment. Now, investment companies, these are companies which are going to pool and manage money for investors. So like a mutual fund company. And now, so you kind of should have an understanding, just being alive in the world, that commercial banks these are generally going to channel deposits to savers and give them interest on their savings to small businesses. Investment companies are going to collect money directly from individuals and buy stocks and manage pools like mutual funds. Insurance companies can also insurance companies don't just only insure products like automobile insurance, but they also do run annuities and retirement plans. So they also can lend money. And investment companies make a big part of what we call the shadow lending industry. Pension funds are going to be organized management of assets for people who invest with them for their pensions. And then hedge funds is separate from mutual funds, but they work sort of the same way. So hedge funds have less government oversight, and they have more flexibility in the types of investments they can make. And think of hedge funds as a very aggressive sort of mutual fund, and mutual funds being really a more standard product, where hedge funds are a more diverse product that utilizes a more diverse group of strategies. Okay, let's move on here. Okay, so households supply the capital, and firms utilize that capital. And that's where stock and bonds come into play because they're the ones where the money is going to go from individuals and flow into corporations, and individuals will have the benefits of stock and bonds for their money. Now, an investment bank is a special type of bank that is going to specialize in accessing the primary markets. So the investment bank is going to have the expertise, the lawyers, the accountants, the market connections to be able to raise money for businesses through stocks and bonds. So they are going to issue new securities, help these companies issue new securities, stocks and bonds in the primary market, and they're going to use their ability as an underwriter to fund these new financial instruments. Now, the secondary market is where these instruments can be retraded, so investors like me and you can buy them. Now, think of it like this. Maybe you buy a brand new video game. That would be considered you're buying a game brand new in the primary market. After you're done with the video game, you want to sell it back into the secondary market. And you can do this through an eBay or through a game store where you sell your used game, and then they're going to take that used game and sell it to somebody else. So they may buy it from you. You spent $60 on the new game. You sold it for $35, and then the secondary market is going to resell it to another buyer for, say, $40. And that's the same thing with stock. One stock is sold in the primary market, and the primary market is where companies get their money. Companies don't earn any additional money when the stock is traded additional times in the secondary market. Just like if you were sold a used game and then somebody else brought the used game back in and it was sold again. So that used game can be sold 6 times, but the only time the company makes money is when it's sold originally, not when it's resold, the company that issued the game. Okay. So investment banks were separated from commercial banks for a long time, especially in the United States. So not so much in Europe, but in the United States, there was a Great Depression, which was affected the whole world. But banks were one of the reasons that aggravated the Great Depression. And because banks took risky positions, a lot of the money that should have been in savings accounts by depositors weren't available for depositors. So that led to a run on the banks. So one way to prevent the Great Depression from happening again was that large banks were broken up into investment banks and commercial banks to kind of separate the activities so that investment banks could do all the riskier activities, but they weren't allowed to accept deposits from individuals, where commercial banks could accept deposits but couldn't make risky investments. So commercial banks, post 1999, commercial banks, investment banks were able to merge, and this created a whole new level of banking again, where the laws were repealed in 1999, and now commercial banks and investment banks could commingle. And then we had the mortgage crisis of 2008, some of it aggravated by these new giant banks. So major investment banks went bankrupt based on these very speculative risks that they took. So investment banks, some of them chose to become commercial banks, which means that they would be able to obtain deposits by individuals and have access to government assistance, but they would also now be more subject to government regulation. So now banks, because investment banks have, by and large, mostly converted to commercial banks, they have much more stricter regulations on them by the federal government. And if we look at the balance sheets of commercial banks, we see that commercial banks have a lot of money in real assets, but much more money in the financial assets, if you see here, much more money in the financial assets. And their liabilities is pretty much the depositors. So if you're a commercial bank, you're receiving money from a depositor, and then you're going to, in some cases, maybe buy some real assets as far as real estate, your locations and things like that, or equipment. But by and large, most of these deposits are going to be funneled through investments to loans and leases to other businesses to make a profit. Now, non-financial U.S. businesses, they have a kind of a different balance sheet as far as we see what their liabilities are more of what they borrow and mortgages, and they have much bigger, they have much more money as a percentage in real assets, but they also have some financial assets as well. Okay. So let's look at equity, how money is kind of proportionally moved around economies, and we have things like venture capital and private equity. So venture capital is an equity investment in new firms. So venture capital could be money raised not through the stock market, not through the bond market, but investors get together and they put pools of capital together and they go out to buy new companies or start new companies. So venture capital is a way of, more formally organizing capital for more direct, pure plays of buying businesses. Now, private equity, this is investments in, privately held companies. So these would be investments that a company, before they go public, they may take some private equity money to expand the business, and thereby, before they're public, they may not be strong enough to go public. So initial stages of a lot of companies, if you look at Facebook and Snapchat and eBay and Netflix, all these big companies, they started out with private equity in the beginning until they got big enough where they could offer stock and access to capital markets. So if we look at let's look at the financial crisis of 2008. So we had there's been a number of crises in financial terms. The 2008 financial crisis was created by finance. The 2020 financial crisis was created by a medical event. And the 2000 financial crisis was created by an asset bubble in technology stocks. The 1998 financial crisis was created by an overvaluation or undervaluation of currencies. So there could be many reasons for financial crises. But in 2008, we had a significant crisis, what we often call the Great Recession, which led to a lot of losses, led to a lot of unemployment, and led to fundamental changes in the way business is done around the world. So let's see, if we look at this slide, the old way and the new way. So the old way is local thrift institutions, which were kind of like local banks, made mortgage loans to homeowners. So you have a local bank, takes deposits, accumulates deposits, and make mortgages. So these banks, which were sometimes called thrifts, would have a portfolio of mortgages that they originated. So their main liability was to depositors. So it really kept these banks motivated to make sure the mortgages, the people they lent to, were going to be good bets, that these people would have a good ability to repay their mortgages and not foreclose on their houses. In the new way that developed up until the financial crisis, securitization came into play. So big mortgage brokers, Fannie Mae and Freddie Mac, they would buy these mortgages from the thrifts and bundle them into large pools and resell them back to investors, which are called mortgage-backed securities. Now, the problem comes is that when you separate the loan originators to the risk from the loan originators to now a securitized market pool, it decentivizes the thrifts from doing their due diligence in originating very low-risk mortgages. And this is what sort of got aggravated through this process of securitization. So in securitization, so the homeowner needs money, right? And the investor wants a return. So you're going to have the originator of a mortgage and the agency who's going to service the mortgage. So this mortgage gets passed around through this process of securitization. So basically the thought is, let me take 1,000 mortgages, securitize them into one giant pool of an investment and sell that to other investors. So this basically incentivized mortgage brokers and banks to create as many mortgages as possible, because they could just sell them to the investment market and get their money back and keep a fee for originating the mortgage. So a number of mortgage brokers and banks didn't care to fully vet their clients who wanted mortgages. As long as you met the ever declining minimums, you would get a mortgage. And the thought process behind this was, well, home prices are going to be stable or always increasing. So if a lender got into trouble, we could just sell the house and satisfy the mortgage. Now, this led into the development of these subprime loans. So these loans were lending to groups and people with very bad credit, very low incomes, and a very poor understanding of financial terms. So the subprime market, the risks were much higher than they were stated, and the loans were very poorly reviewed. Oftentimes, almost no documentation was needed. The loan to the house value, oftentimes people would borrow 100% of the house value, perhaps 110% of the house value, or might have adjustable rate mortgages where the low introductory rate that would often balloon in 2 or 3 years after the mortgage, pretty much inherently guaranteeing a default. And this is what occurred. So we see a long history of housing price increases. So as long as housing prices go up, these defaults are often unnoticed because the house can be resold at the same price or higher than the mortgage, so there's no financial loss. But once housing prices go down, now these houses are what we'd say underwater. So a lot of homeowners will walk away from them rather than owning an asset that's worth less than they paid for it. So along the way, these mortgage derivatives were created, which we would call a CDO, collateralized debt risk, collateralized default risk. And so basically it's a derivative based on breaking out the risk and for one class investor and dividing payments into different tranches. So basically you could take the 1,000 mortgages and you could say, you're going to be just invested in the top 80% of that pool. The bottom 20% would be a different tranche or slice. Tranches are French for slice, which most of you know that. So, and it was an effort to make the investments in these mortgage portfolios higher ratings. So the rating agencies would issue very high or safe ratings on these mortgage derivatives based on this consolidated default risk, which was meant to minimize these positions. In addition, something was developed called a credit default swap. So credit default swap is similar to a CDO. So the credit default swaps are a way, when you say swap, it's like trading the risk. So an insurance contract against the default of one or more of the borrowers. So it's basically a way of the purchaser can swap or pay an annual premium, like an insurance premium, for the protection from credit risk. So these credit default swaps was an alternate method to basically a credit enhancement. So it allowed investors to buy these subprime loans and insure against their losses or guarantee against losses with them. But the problem was that the people who were assuming the risk were assuming much more risk than they could support. And AIG is an example of a company that had much more risk traded than they could actually support. So the thinking by IGA was that they could take on much more risk than they can actually compensate against, because the chances of most of that risk coming due was very small. But unfortunately, they didn't realize how poorly the loan, the underpinnings of the individual mortgage participants were, that made the whole chance of this risk coming into play much higher. So the systematic risk was basically accumulated in the breakdown of the financial system. So there was a spillover from one market into the other where the credit seized up. So banks being highly leveraged, they didn't have enough liquid asset. And the exchanges becoming insolvent. So basically the sort of like the oil, which is money, drained out of the financial system, which is an engine, and the financial system was about to freeze or cease. And when this started to occur, the stock market reacted violently, falling stock prices, because one bad thing after another started happening, where Freddie Mae and Freddie Mac, these big mortgage supply companies, they basically broke. Lehman Brothers and Merrill Lynch were very close to bankruptcy. The U.S. government had to step in and basically lend some of these companies money to keep them operational, and also extend billions and billions of dollars into the credit markets to put that oil back in the engine to help prevent a panic, which was going to, again, freeze the markets up even more. And this is what you could see as, if you look at this is going to look at the treasury rates and the spread between the 3-month LIBOR rate, which is a London rate, versus the treasury bill, and then the what we call the TED spread, which is a measure of risk, a measure of bank insolvency fears between the two parties. So the freezing of the credit markets at the end of the day is basically what drove the financial crisis to be as acute as it was. So the larger companies that had relied on the commercial paper market were now unable to raise funds to keep their businesses. So, of course, banks found it difficult to raise funds as well, and that's where we come up with this TED spread. So a bit more specific, the TED spread is the difference between the 3-year Treasury bill and the 3-month LIBOR rate based on in U.S. dollars. So to put it another way, the TED spread is the difference between the interest rate on short-term U.S. government debt and the interest on interbank loans. So this, generally they run pretty close together, but you could see here that during the financial crisis, things got really out of whack, where they started to diverge. And that's typically a sign of financial distress. So with banks unwilling or unable to extend credit to their customers, thousands of small businesses who relied on those loans and lines of credit became unable to finance their normal business operations. And as business started declining and they needed that money more than ever as business activity started declining, of course they had to lay off employees, which led to a higher unemployment rate. And overall, the economy was, in the worst recessions it suffered since the Great Depression. So the financial markets and the worry about the function of financial markets quickly spread over to the dysfunction of Main Street. And that crisis directly led to stock investors fleeing stocks, fearing the declining value of stocks based on their reduced revenues and profits. So you can see, how devastating this was if you lived through this period where people were getting laid off, companies were closing, governments had a hard time receiving enough tax revenue to run their governments, and the whole system was thrown out of whack, all because these financial risks were piling up and no one was realizing the magnitude of these risks. And when the risks were realized, then the economy and the markets had to snap back to accommodate the realization of these new risks. And it's through something that strong happens in the marketplace, there are consequences or a snapback. So as a result, the U.S. government created this Dodd-Frank Reform Act, and the purpose behind this act is to prevent the Great Recession from reoccurring. So they developed stricter rules for banks as far as they are able to raise capital, the liquidity positions they hold, and the risks the management are allowed to take. And they mandated an increasing amount of transparency for the banks. They clarified the regulatory system for the banks, and they created this Volcker rule, which I don't have on the slide. So Paul Volcker was a Federal Reserve president back in the 70s and early 80s, who was very successful in taming inflation by raising interest rates, creating a recession, but thereby starting one of the longest economic recoveries for the U.S. in his ability to tame inflation through the raising of the federal funds rate. So he was considered a very successful, very smart Fed president. But later, this Volcker rule, which was named after him, created limits on the bank's ability to trade on its own accounts. So basically what it means is that the banks can't take risky bets on their own accounts in other businesses like a hedge fund or a private equity capital can. So this makes the banks a little bit safer operationally because it reduces the risks that they can take with the capital that they have. Okay. And this was meant to hopefully overall stabilize the economy and make the banks, prevent the banks from creating such a disaster again in the future. Which is interesting because they created a similar disaster in the Great Depression, and then the laws that were enacted in the Great Depression were reversed in 1999, only for, it took only 7 years later for that to reoccur. Not exactly the same way, but you get the message here is that U.S. banks left unregulated, unfettered, will naturally gravitate towards riskier and riskier bets in order to enhance the profitability of the bank and thereby, in some cases, creating an agency issue if individual bank managers are profiting from profit share incentives. Anyway, if we look at the cumulative returns in the S&P 500 over the last close to 40 years, you see here, this is the dot-com bubble burst and stock crash, followed by the 2008 Great Recession stock crash. And then ever since then, we've been on the longest recovery until 2020, and we had another stock market bear market that in the long run, it's a short-term decline in overall stock prices that will be quickly forgotten once the current financial crisis is abated, and then stocks, if they follow their traditional pattern since the 40s, will continue to rise, and we'll see stocks hitting new highs in only just a few short trading years after these current issues. Now, moving on to the end of this chapter, as we move through this lecture series, following chapters will discuss the financial markets, trading methodologies, portfolio theory, talk about debt securities, equity securities analysis, that's the stock analysis, both fundamental and technical, and we'll dive into some of derivative markets and look at some investing strategies. So stay tuned for those future lectures. Thank you for taking the time with me today, and I hope you enjoyed this lecture. I'll be looking forward to talking to you again very soon. Thank you and take care.